Welcome to the DeFi podcast, where we attempt to imagine the future of crypto, because foresight is what makes great investors. This podcast is for informational purposes only and should not be relied upon as a basis for investment. All statements made by hosts or guests are strictly beliefs or point of views and are not recommendations to buy, sell, or hold any security. Hosts or guests may hold certain securities discussed in this podcast.
Good day. Hello, everyone. Welcome to this week's episode. This week we are talking with Coinflip from GMX. He is the head of business dev at GMX and part of the core team. Welcome, Coinflip.
Welcome to the show.
Thanks so much for having me.
So I think what we're going to do is we're going to have this conversation in two segments, and this is really part one. We're going to discuss the evolution of GMX, how we got to where we are today. And in a few months, when GMX launches its synthetic assets products, we are going to have a follow-up conversation where we discuss those in depth, and we're going to dedicate that whole episode to that. Sounds good?
Sounds good.
Okay, so let's talk a little bit about GMX. I think a lot of our viewers are Avalanche-focused DeFi people, and they may not know the history of GMX because it didn't start on Avalanche. So I'd be very curious to hear, like, from the beginning, what is the story until today?
Yeah, so you're very right. We didn't start on Avalanche, but we definitely do consider Avalanche our home as well. As a protocol, there's a bit of a history that sort of brought us towards GMX and the DAO that now runs GMX. We had a lot of contributors, namely our lead developer X, who started sort of in the DeFi space more actively in 2020 with a project called XFix, which really focused on a few ideas in and around token inflation, token deflation. How do you, again, replicate certain concepts from the traditional financial world into an on-chain experience? And it led to a number of experiments with leveraged tokens. Very interesting in concepts that, we've seen actually this year. Other protocols effectively built things very similar to that, which were sort of, done about 2 years ago, but faced challenges because of, on-chain costs when we were on Ethereum, fragmented liquidity. And as we sort of, as a lot of the community looked at those problems, the question was put out, well, what should we do next? And what's the thing to do? And fragmented liquidity tended to be the problem that we really ended up focusing on. And it sort of led to eventually the Gambit, which was a deployment on BSC early in 2021, which was a product very similar to what GMX is today. It really brought forward, liquidity providers, providing passive liquidity, all backed by Oracle pricing to provide a liquid on-chain market. There were limitations that BSC had at the time. I mean, I think BSC was kind of at the forefront of creating a low-cost EVM chain, and they really, I would say their volumes, obviously, if anybody remembers that DeFi summer, were off the charts, and they did struggle, and it created some issues for us as a platform. And after some retooling, we have finally launched in September of, technically August, the end of August, but September 1, you could say, of last year on Arbitrum, along with the launch of Arbitrum itself. And we've been sort of going from strength to strength since then. I mean, we've been really happy. January of this year, we launched on Avalanche. It's the GLP, which is the liquidity pool that underpins GMX, is now touching roughly about $90 million on Arbitrum, on Avalanche. It's the single largest liquidity pool on the chain, and provides deep liquidity for people to, leverage trade and swap trade, ETH, BTC, AVAX, obviously, and currently the USD stablecoin.
So you mentioned liquidity fragmentation was one of the problems that you were grappling with initially. Can you define that term a little bit more?
So the issue we were looking at was that, when working with leveraged tokens, we found, you could launch marketplaces for, let's say, a 3x leverage, a 10x leverage, and create a market where, there were economic incentives for people to take the counterparty side on those positions. But when liquidity has to be provided and traders have to take, enter individual positions, it starts to become very capital inefficient, and you end up with the liquidity that's available being fragmented. And you can look at this as two ways. There's people who are, they arbitrage, they enter markets, they help to keep markets in balance, and there's others who have a directional bias, what I would call a trader, somebody who has a view that I believe that Ethereum is going up or I believe that Ethereum is going down. And they need ideally as close to a perfect market as possible to be able to enter and exit and do that efficiently. And we realized that fragmented at that stage, fragmented pairs and the like were actually a barrier to being able to create deep liquid markets. And there was always this challenge of how do you bootstrap up liquidity when if you have very little liquidity, the impact of trading can be quite excessive. And that's kind of some of the issues that we started to look at. And again, to be very clear, the amount of liquidity that was available for an ideal like leverage trading on chain at the time was close to zero. And so, when Gambit and then GMX came up, it was really about how do you create a framework that allows traders to get that clean experience, do it on chain without delay, and obviously ideally do it in a way that allows any passive liquidity provider to be well compensated for helping to create that liquid market.
Is it much harder to execute, for example, a trading platform or also like a futures platform on chain as opposed to just...
Well, there's two ways to think about that. I would say that, in the end, the pieces are all the same, but it comes down to a series of trade-offs. The same way that in a private environment, you'll make a lot of trade-offs in terms of server capacity and complexity of being able to handle information, latency issues. We end up dealing with all of those issues, but we also have the fact that there is a relatively higher compute cost for doing transactions on chain, and you need to find the right balance where it can also still be cost effective for people to trade on chain, and that transactional costs, don't outweigh the benefits of that transparent, environment that's being created. So I would say that a lot of the challenges do come down to two factors. Data latency is one thing that we spend a lot of time dealing with because we do work with oracles to help mimic the wider market for getting that reference pricing. And then transaction cost. We would have, I will still say this, we love our experience on Arbitrum and Avalanche, but, there's no doubt that Ethereum is sort of the home of DeFi, the place where you would say the biggest trades happen. It's just simply not a viable environment for creating the type of experience that we have. It's, transaction time to settlement takes too long. Transaction fees are too high. It doesn't allow us to be able to create that environment. So I think that's where a lot of the challenges you would say come from. If I might also say, but that's also why I think that in many ways, something like Uniswap arose out of those limitations. It wasn't an ideal environment for an order book. Finding ways to deal with it algorithmically made more sense. What GMX and what others have done has continued to take that building block and take from it what I think there has been the strength, which is creating a framework where a passive liquidity provider can actually earn a yield for the work that they're allowing their capital to do, and do that though again in an environment where it's verifiable. It's not like you hand somebody your money and hopefully they send it back to you with some yield. You can see where that yield is coming from. You can see the activity, and I think that's also been very democratizing in terms of sharing that opportunity that market makers make as a business, but just to passive retail investors.
What's the experience been building on BSC versus Arbitrum versus Avalanche?
So I think one thing I will say is, while I spend obviously a lot of time as a core contributor of the protocol, I'm not a developer. I don't write code myself, although I have, I have immense respect for our team that does. I mean, it's quite often, it amazes me what they do. I think at a certain point, a lot of the experiences are converging. I mean, a lot of our issues with BSC were, I think in time they've worked to correct them, but at the time they could have been catastrophic, and because you were just dealing with a lot of latency. The chain itself was kind of grinding down. So, it's hard for me to say specific differences. I mean, I'll just say that, you know, I know that all chains are working on two or three key things, which is, obviously giving that predictable costs, I think, are important. But invariably, it's a public marketplace, and so you will have volatility in fees, and I think that part is okay. I think the idea that a lot of them are now working to do, their own variants. Avalanche has subnets, which they've used to move what I would call low value computational work, and things that require relatively lower security off chain into, like Kribana, for example, was such a big part of the Avalanche and is part of the Avalanche ecosystem, but has moved off, which has helped to manage chain load. Arbitrum has their own concept called AnyTrust, which is a slightly different take technology wise, but to again allow people to utilize the technology stack that Off-Chain Labs has made. And BSC, sorry, I don't remember the name, but they've also gone about that same process, because BSC has definitely been a big player in the game space. So I think all of them are tackling this idea that it's you kind of need to create environments where DeFi protocols can work together composably, and hopefully in a predictable environment. And I think to me, that's kind of the holy grail, because the moment you remove that composability, I think you've really lost a lot of what the improvements that we're able to make with an efficiency in the system that a lot of the DeFi is helping to unlock.
So until synthetic assets come along, until that product is launched, clearly the most popular, most important product for GMX currently is the, I'm going to call it leverage perp trading. Is that correct?
That's correct. I mean, in many ways, I would say that is our product. It's leverage perp trading makes up on any given day 80 or 90% of, call it, the revenue generation and volume of the platform. We do have swaps. It's a business that we would love to continue to expand on, and we're working on as part of what we do with we'd love to, we really would like to tackle it, and I think we've even shared proposals for eventually a protocol called X4, which is kind of a new AMM. But we right now our focus is on synths, because we definitely see a lot more value add to our users to be able to expand our offerings into more assets than we're currently able to support.
Yeah, it makes a lot of sense. I think there's quite a need for synthetic assets as well. So very curious to see how this works out, but we'll keep that for the next episode. So I think it's safe to say that leverage perp trading is the main offering that you have currently. Would you be able to tell us how the process works, underlying like the user experience? What's actually happening under the hood?
Yeah. So when you think about from a user experience, we try to keep it relatively simple, which is you can come to the site, you can choose the asset that you'd like to be able to long or short, in terms of call it basically adding risk or hedging against risk. The level of leverage, which is the amount of assets that you'd like to be able to borrow in terms of creating your position size, and executing that with a series of simply approving the transaction and then being able to execute the transaction. Feels very similar to effectively doing a swap trade on Uniswap, or actually very similar to the trading experience for somebody on a centralized exchange. But in terms of what happens, called under the hood, all trades on GMX are backed by a single liquidity pool which we call GLP. It's roughly about 200 million on Arbitrum and about 100 million on Avalanche. It's basically a pool made up of blue chip assets. So talking about Avalanche, AVOX, ETH, BTC, and USDC. And whenever you open a trade, to use an example, let's say you wanted to open a 10 BTC long, which we'll call $250,000 today. Effectively, 10 BTC are taken from that pool and set aside, and 100%, so one-to-one backing your trade, so that you can enter that trade, and you're paying a small fee to open and to close the position, and you're paying an ongoing funding fee or borrow fee, however you want to term it, for keeping that position open. And the GLP is there with those assets to back that trade until you decide that you'd like to close that trade. And what it does is it basically means that you don't need to worry about thin liquidity. we take our pricing from the leading deep sources of liquidity within the crypto market. Today, that's centralized exchanges, you know, Binance, FTX, Bitfinex, and we use them to get reference pricing. And we utilize that reference pricing to help you open your trade, close your trade. We also use Chainlink oracles to help make sure that all pricing is within a tight band of what we would consider a universal pricing for these assets. We use that same Chainlink pricing to ensure that if you're liquidated, it's done based on a separately verifiable on-chain pricing oracle. So as a user, you basically can ensure that you're not subject to the whims of a single exchange with thin liquidity. It's based on the broader market. You have that comfort. And I think one of the really interesting aspects that we've done is because as a protocol, I think there's many places where market makers and high frequency traders can operate, but a platform like GMX is really about people, as I said, offloading directional risk or deciding to take it on. And or when the order comes in, so you submit your transaction, within 1 second we query, confirm what the market prices are, and we execute you, better or worse, subject to your own tolerance limits, like a slippage, at that market price. So if you decide to buy, and in that 1 second the market were to go down a little bit more, we'll still execute you at that better rate. We're not, we're really just looking to help make sure that it is a experience that just reflects what the market is and be able to provide that to you on chain. So as I said, for a trader, it's kind of almost a very clean, simple experience, and behind the scenes, it's backed by a deep set of liquidity providers. And what's been very interesting about this, by the way, I should say, is we spend a lot of time tracking. As I said, you won't find market makers and big traders like that on GMX. It is community and retail traders, and likewise the liquidity is coming from the same sources, which is I think also been a real strength for us.
Yeah, it's very nice. And how would you contrast this to a centralized exchange that is doing perps or offering a similar service? Like, is the process completely different for them, or is it somewhat similar, but the funds are just private? How does that work?
So I would say that on most centralized exchanges, the process behind is quite different. And the reason I would say it's different is, well, in two fashions. In the end, it's all done by, most volume on centralized exchanges actually come from market makers who are either there on a set of preferential terms to help make those markets, to ensure that there is a buyer and a seller on each side of that market. And many times they all operate with their own different strategies as to how they'll provide liquidity. But in the end, that same liquidity could be, they may be attempting to provide market support in many different exchanges, and you may enter a lot of exchanges where there just isn't that same depth of liquidity. And so you kind of are always at that stage reliant, when you want to enter a position on one of those exchanges, on who's present there, and if they're willing to keep those orders in the book. So I think that's where you start to get, a lot of differences from, I guess, an order book system that you've got over there. And I think a reliance on very large private liquidity providers, which both on centralized exchanges and even some decentralized exchanges have a really outweighed influence in terms of how fees and incentives and the entire structure is sort of designed to, I would say, I guess it happens in all business, but to favor themselves as opposed to, a retail trader who may be coming in. So, I think a lot of that is, I think, where a lot of the big difference is. For us, the entire framework was sort of established by the community that's now turned into a DAO. It's, we can't make changes. We sort of treat all traders equally, for the lack of a better term. So I think it's ended up creating a very different trading experience.
Just to reiterate, essentially on GMX, there is no market maker. GLP acts as the liquidity provider and the market maker, correct?
Absolutely. And that's the point, that if you think about it, they effectively, the fee that they earn reflects all performing those functions and also being willing to be the counterparty, which means there are occasions where GLP may be a little bit more long on assets than maybe we would ideally want, or be a little bit shorter. It's effectively doing that entire function that an OTC desk. Back in the in the TradFi world, it's actually what an investment bank would do for you. They would happily take on for a reasonable fee that exposure, and then over time, you know, hedge that out or whatever that process might be. And we have mechanisms that sort of naturally bring us back to our target weights, and it's worked well.
So democratizing finance, I love it.
Absolutely. I mean, we don't like to talk about it. Or at least I don't like to talk about it that much. But if you actually look at the returns the liquidity providers have made over the year, it's been quite stunning, and especially during a period where the market itself has been generally down. I mean, liquidity providers have consistently earned strong yields over the course of the year, and largely because of, not because I would say traders are good or bad, but I would say that leverage definitely is one thing that can cause people to exit positions at suboptimal times. It's resulted in GLP, I think, between Arbitrum and Avalanche traders being down roughly 40 million, which has just continued to provide added returns to liquidity providers.
Right. We've been filming for quite a bit, and I think this is a really great intro and primer to what GMX is. I would advise anyone watching who wants to learn more about the GLP token and the GMX token can watch a recent AMA that we did with GMX, with Coinflip, on Moremoney Finance. So just find the Moremoney Finance YouTube channel and you will find this interview. So we don't want to rehash what's already been discussed here. So if you're curious about the tokenomics, that's a good place to start. And I think this is a really great primer on GMX. And we would love to, we'll have the second conversation when you come out with this new product that is very exciting, in my opinion. I don't know if anyone has any closing thoughts or questions, but I would be good to wrap it up here.
I just wanted to thank you for having me over today. They've been great conversations.
Yeah, thanks a lot.
Thanks for
and we'll follow up soon. Okay, everyone, if you're still watching, please follow us on all the platforms, Twitter, YouTube, etc. It makes Jared very happy. We'll see you soon. Bye.